Hi friends. In the last 2 years, Nifty IT has been down by close to 11%. Also, if you look at individual stocks, so for example, Infosys, if you look at that, in the last 1 year has given close to 2.39% negative returns. Last 1 month, it is down by almost 5%. If you look at HCL Tech, another very big IT company, in the last 1 month, it is down by 2.23%. Look at TCS, number one IT company, is down by 1.48% in just last 1 month. Overall, there is a negativity about IT stocks in the market, and people who hold these IT stocks, they are sitting on the fence and are thinking that actually this is it for IT sector. IT stocks are coming down, they are going to crash. And also news like this, that IT firms are delaying the campus hiring because there is low demand visibility. Also the hiring outlook for Indian IT industry weakens on global macro woes. All of these news are making investors panic at the moment, and many of the investors are selling the IT stocks in the panic. So in this video, I'm going to help understand what is the reason behind these stocks not performing well, and more importantly, what is the future outlook for IT stocks. Also, I will talk about TCS Buyback briefly. This video is going to be very interesting. Stay tuned. So if we look at the quarterly revenues that the Indian IT companies have generated, have a look at my screen and you will see in the true dollar terms only, without putting the Indian rupees into this picture, you will see from September 2022 to 2023, continuously, TCS, which is in the red bar, the revenues have been falling consistently. If you look at Infosys in the yellow bar, again, Infosys has also been falling consistently. And if you look at the blue bar, HCL Tech has also been consistently falling, albeit it is falling at a slightly lower rate than the TCS and Infosys. Now, because of this revenue fall in terms of the dollars, what that has done is that investors are giving up on IT stocks, and they're saying that, well, the growth is not there. Maybe these IT companies are not performing, they have matured, they don't have any innovation going on, and they are building their own theories and dumping IT stocks. But what we really need to do is understand the reason behind it. And let me give you a very simple explanation for this. So what you see on my screen is US Fed rate data. And if you see, from around March 2022, the Fed started to increase its Fed rate from 0.33% to right now it is at 5.33%, all-time high. Now this continuous increase in the Fed rate from 2022 until now, what that has done is that it has made the borrowing difficult for businesses in US, because US Fed rate is the interest rate at which the US Fed Bank will issue the borrowings to the US banks. And if it is higher, then US banks are going to also lend to the businesses at a very high rate. And when that happens, US businesses will find it difficult to borrow more money. And the first thing they will do is they will cut down on IT spending. And this is where majority of Indian IT companies are relying on the US businesses. Their revenues are likely to see some fall. But more importantly, if you look at the future, what is likely to happen is that these Fed rates are not going to go very high now. There is a chance that before this year closes, Fed might go for one more increment. So these rates are going to come down in the next year or so. What that will mean is that the pressure on the economy will ease down, and then companies will be able to borrow more money the moment these Fed rate starts to come down, and we will again see a lot of IT spending. Now, nobody can predict and guarantee that these rates will fall down immediately. What Fed is saying is that these rates are going to be higher for longer, meaning that these rates may stay higher for some longer time. It might take 2 years of time for these rates to be normalized. So the key takeaway is that right now the IT stocks might not be performing, but in the next 2 to 3 years, there is going to be a rebound here. And more importantly, if you just read these 3 lines from the September quarter results, you will see that the total contract value for Infosys in this quarter has been $7.7 billion, which is more than $2 to $3 billion they generally will have. Likewise, for HCL Tech, the total contract value is been around $4 billion compared to $2 to $2.5 billion. And likewise for TCS, it has stood at $11.2 billion. What are these numbers? Let me quickly break it down for you. Total contract value is the value that the company has signed in terms of the new contracts or new projects. And if the 3 big IT companies are signing the contracts of this scale that has given close to 2 to 3 times more run rate than the previous quarters, what it tells me is that the pipeline right now is looking solid for this quarter's perspective. And also please understand that this total contract value do not immediately start to give the revenues. If you have IT background, you will very easily understand that if a contract is signed for, let us say, $5 million, you don't immediately start to get that revenue. It will take at least 1 year or 2 years of time frame for you to start getting those revenues. So in my view, in the next 2 to 3 years, the pipeline is already starting to look really good now. What will happen in the next few quarters, I cannot guarantee or no one can guarantee. But to me, this is a very positive sign for IT stocks that they are going to perform well from here on if we wait for another 6 months to 12 months. Another very important macro factor that all of us need to understand is, have a look at my screen and you will see that in September 2023, the number of jobs that was created in US has gone up from the August month, from July month. Nobody was expecting it because Fed rate is all-time high, meaning that job creations in US will not be there. But September month has defied that concept totally. And if I come down because of this data, people are saying slow down. What slow down? Because if the US economy is now creating more jobs, that it means that it is defying the entire logic of high Fed rate and mild recession that people have been talking about in the upcoming months. If this continues in the next few months, if the job creation continues at a higher rate, then there is not going to be any US recession, and that is going to directly benefit Indian IT companies. I hope this entire narrative is very clear to you. If you have not understood anything in this, I would request you to watch it one more time, and if you're still not clear, let me know in the comments. I will try to simplify it for you. Let me now quickly talk about the TCS buyback that has been announced very recently. What you see on my screen is I am on the TCS website, and what they're talking about is 1.12% of the total paid up equity is the offer for, and the price that the company has decided is 4,150 rupees. Immediate question that many beginners have is that, Rahul, right now the TCS's share price is at 3,500 rupees and the company is willing to buy at 4,150 rupees. So it's a good time to make money. Yes and no, both. Let's understand the calculations in a very simple way. So if I go to a recent article published by Times of India, you see a simple calculation done by them. So let us say right now you go ahead and buy 48 shares from the market and at a price of 3,542 rupees for the calculation purposes here. That would mean that you would have invested around 1,70,000 rupees in TCS right now. By the way, this is not a recommendation. I'm just running you through some sample examples so that you understand the nitty-gritties of buyback and how much of profit you can potentially make. Now comes the second most important line here, which is the small shareholder acceptance ratio, meaning how many of these 48 shares are likely to get accepted by TCS. Now, if you look at the past trend and past buybacks that TCS has done, in 2017, 18 and 20, it was 100%. So if you had 48 shares, TCS will buy back entire 48 shares from you. But in 2022, the acceptance ratio was only 20%. So we don't know what is going to be the acceptance ratio. It will be determined very close to the record date and we will only come to know at that time. So for the purposes of calculations here, let us assume 4 scenarios: 25% acceptance ratio, 50%, 75% and 100%. So that will mean in the scenario number 1, you will tender back 12 shares. Scenario 2, 24 shares will be given back to TCS. 36 and 48 and so on. Now the buyback price the company has fixed is 4,150 rupees. So in scenario 1, you will get 49,000 rupees back. In scenario 2, 99,000. Scenario 3, 1,49,000 and so on. So with this, you will be able to make profits of 11,000 rupees in scenario 1, 21,000 rupees in scenario 2 and so on. That means 4.5% return in scenario 1 on your investment. And if the acceptance ratio goes up to 100%, then you are likely to make 17% of profit. But please also understand, if the acceptance ratio is lower than the 100%, then the remaining shares you will have to hold, or you can sell it at the market price. Nobody can predict what the market price will be at that time. You might incur some loss, you might incur some profit. So with this, you understand the entire calculation of the TCS buyback. I hope that you found it useful. If you like this analysis, simply hit the like button. And if you did not like this analysis, let me know in the comments your reason of not liking it, and I will try to improve. Also, you can consider subscribing to my YouTube member community because I post in-depth exclusive analysis on stocks and mutual funds. So for example, recently I posted on TCS buyback a detailed write-up and my views on TCS buyback. All of this timely information will help you make informed decisions. I hope you enjoyed this video. I will see you in my next video. Until then, keep rocking.